Again, remember, a Roth conversion is different than a contribution. A contribution is where you take new money and put it into a Roth. A Roth conversion is where you take existing money that has been pre-taxed, perhaps in a 401k. Some plans will allow it, very few.
Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, hello, everybody, and welcome again to another episode of Reynolds Wrap. Of course, I'm Don Reynolds, and my good friend Corey there.
Yeah.
So I hope everybody's doing well. Fall looks like it's starting to set in a little bit, so I guess that's what happens, right, in Minnesota?
A little lower humidity. I welcome that, personally.
It's been a beautiful September, though. That was one of the most mild Septembers I can remember. That's
very nice.
Sure.
Yeah, they're even talking some good weather in early October here.
Yep. So today we thought we'd talk about, if you will, moments. There's 8 really moments to move your money.
Yeah.
And, I guess what we're going to do is just kind of highlight these. First one, it's about rebalancing. I think every once in a while, a person has to look at their investment account and say, okay, where am I sitting at? Am I aligned with what's going on in the economy?
Yep.
I know there's a lot of uncertainty, a lot of people right now with the election coming up and where that's going to end and how's it all going to shake out and how will it affect us? And so we understand that. And so now might be a time where maybe you want to rebalance a little bit. Market's all-time highs. Should you take some money off the table right now? I don't know.
Well, maybe it aligns with the risk assessment too. For a lot of folks, we find is that time happens, and a lot of times we don't have a true risk assessment done. I know here at Strategic Asset Preservation, anyone that's a client where we're investing money for them, it's every 3 years we want to do that, and that's minimum. We might even do it before then, and with life changes. So, when's the last time you've had a risk assessment to see where you are with the risk tolerance and what stage are you at in your investment career, and then make sure that investments do align with where your risk is. So, anyhow, that's a very important reason to move your money. And I know another one on the list is, and we've talked a lot about this in the past, is Roth conversions. We're big proponents of looking at tax planning, as you know, and Roth conversions fit into that tax planning. Again, remember, a Roth conversion is different than a contribution. A contribution is where you take new money and put it into a Roth. A Roth conversion is where you take existing money that has been pre-taxed, perhaps in a 401k. Some plans will allow it, very few, but mainly in a traditional IRA, and then convert it to a Roth IRA. So you're sourcing the money in a different format into a Roth, and you pay taxes on those dollars the year you do it. So that's another extremely important reason to move your money. And again, with taxes, again, at historic lows, it's a very important time to look at perhaps moving money into a Roth.
Yeah, and now is the time of the year to really be looking at that. For our clients, we always wait till, November, mid-November. Just for the fact that we've learned the hard way, if you do it early in the year, then life happens and all of a sudden they need more money, and then it can cause a tax burden. So we're very careful about that. And so now we're just saying now's the time to really look at that. Another thing is in-service distributions. When you leave an employer, obviously your money is 100% liquid in your 401k at that point. You do with it whatever you want. But at 59 and a half, and I would say probably 95% of employers, maybe even higher number than that, because back in '08, which a lot of people forgot about, but when '08 happened, they changed the rules on this and allowed people to do what's called an in-service distribution. So you're still employed with the company, but at 59 and a half, you can now take that money and, if you're getting a risk averse, getting closer to retirement, you want a little bit more safety, you can move that 401k into an IRA. It's a tax-free rollover, so you're not going to have a taxable event occur to you. But we see a lot of people that are taking advantage of that. It's about, again, knowing that that's out there. And all you got to do is call your HR department. They'll let you know. So, and again, if you're leaving the job, well, then it's basically the same thing. You can take that money with you. So
we're big proponents of that. Once you leave a job and or look at potential in-service distributions, often 401ks can be more restrictive once you roll it out into either a traditional IRA or Roth IRA or whatever the account you need to roll it into to make it a tax-free event. It opens up additional possibilities, not only for beneficiaries should a tragedy occur, but also for investment options. Another reason to look at one of the 8 to move your money would be if the fees are too high where you're currently at. Again, here at Strategic Asset Preservation, we're big proponents of making sure that fees don't erode your value and having competitive fees. There are often a lot of different investments that we'll use here that is more of a commission product where there are no fees attached to it potentially to you as a client. And then when we do look at investing securities, we do have fees there, but again, we're very competitive because let's face it, fees can erode your money and take away from any returns of that year. Or if it were a down year, can of course erode the money even faster there. So you want to be a cognitive of just what are your fees and the investments where you're at, the accounts where you're at, and make sure again that you speak with us and we can show you what our fees are, and maybe that's another reason to move your money.
Yep. And then again, underperforming is another one.
Yep.
And this kind of comes back to, the first thing that we talked about is, rebalancing your account. I guess, if you've got underperforming assets in your investment portfolio, maybe you want to do some evaluation of that and see if, you look at, your whole portfolio and you see you got a bunch of them that really aren't doing or keeping up with what a lot of the rest of them are. Well, maybe you need to, again, rebalance and relook at that. So, And then I think, a time horizon, I think that's very important too.
Absolutely.
Life comes at us and, maybe things have changed in your life where now, retirement was maybe 5 to 7 years out, maybe 2 to 3.
Yeah.
And so now you got to look at that. What should I be doing with my assets today?
Yeah.
Because my retirement's coming a lot sooner than I originally was looking at.
Or if it was postponed out. Maybe maybe you decided to work longer. So now you've got a longer time horizon. And maybe then you need to get back into some more risk perhaps or whatever the case may be. I mean, there's an age-old rule out there called the rule of 100. And if you take your age and subtract it from 100, that's about the percentage of your overall assets you should have at risk. That's just a high-level overview of a quick risk assessment. So again, depending upon your time horizon, we can, in your risk assessment, defer from it a little bit. But whether you tend to work a little bit longer or retire earlier, very, very good opportunity and chance you need to look at moving your money.
Yep. And then I think the last thing, it's consolidating your accounts. And what we mean by that is, and we see a lot of this, people have, they got 18 different accounts and a lot of them are the same type of accounts, but they're at different places. And I understand diversification, don't get me wrong, but maybe you want to get, everything more consolidated, especially as we age, it's harder to keep track of all this stuff. And so we just feel like, if you've got 4 Roth IRAs and they're at 4 different places, maybe you want to consolidate those into one that you feel has performed the best, or if you're not, risk adverse with it, then maybe I'm going to put it where I know I don't have risk to the money. But as we get older, it's harder and harder to keep track of this stuff. And so we just think it's important to, make sure that you're not scattered all over the place. I mean, I'm telling you, I'm serious. We have people come in and they got so many different things, so they don't even know what they have.
The same, laughing a little bit because I can think of a couple of clients that we onboarded and had as clients, and maybe it was 2 years in one case, and it might have even been 3 or longer in the other case, where all of a sudden they brought a statement in. They said, I didn't even know I had this account. Finally opened a mail or an envelope that I got, and I got this account, and there was 50,000 or 150,000. So again, keeping track of all the accounts and the money you have where they're at can be cumbersome, and consolidating is a very, very valuable reason to reallocate, remove your money, and look at again where you want to work with and who you want to work with going forward.
Right.
Absolutely.
So there really are, and I say strategic moments, but there are times when it, your progress, your financial progress, when you should consider moving money. And if you've reached any of these milestones or things that we just talked about, we'd be happy to sit down and share, our thoughts and ideas. As you know, we offer a free complimentary what we call discovery meeting. And it gives you a chance to meet us, hear what we do, And then obviously the same thing, we get to meet you and listen to what your needs and goals, objectives are. But we're happy to do that. You can call 651-773-3859. Again, that's 651-773-3859. And we're happy to share our time with you and our knowledge and see if there's things that we can help help you to understand so you can make good moves.
Absolutely.
With that, we want to thank you all for your time. Have a great day.
Yeah, thanks everyone. Appreciate you listening in.
Listen to more with Don Reynolds and Corey Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.